Are you looking to build a solid financial future? If so, you've come to the right place. Today we're going to show you how investing can be simple and accessible for everyone. While I can't promise you that you'll become a millionaire out of this, what I can help you is understand how to make smart, informed investment choices that will lead you to building wealth over time. If you're looking to grow your wealth through the stock market but don't have time to pick individual stocks, don't have time to research individual stocks, well then don't worry about it. Because what I'm going to show you is that you still can build wealth over time in the stock market through these all-in-one ETFs. Without further ado, let's jump right in and take a look at these all-in-one ETFs and take that first step towards smart investing. But don't forget to hit that like, subscribe, and thanks button on the bottom of this video so you don't miss out on future financial insights. First of all, what are ETFs? Because before you can compare one ETF to another ETF or multiple ETFs, you have to understand what ETFs are. ETFs are essentially a basket loaded with stocks or bonds, and they trade on an exchange like the Toronto Stock Exchange or the New York Stock Exchange or any other exchange. This means that you can buy 10 stocks, 100 stocks, 1,000 stocks worldwide with just one transaction based on the ETF you choose. So as you can see, ETFs are so powerful and they are perfect for beginners. They are a blessing for beginners, in fact. Because with one transaction, you are diversified across all sectors, across all industries, across all geographies if you really want to. Instant diversification is super powerful and it can be super simple with these all-in-one ETFs. Now, not all ETFs will offer the same level of diversification. It really depends on which ETFs you choose, and that's what this video is really about, helping you choose those ETFs that offer maximum diversification. And that right there is the key to reducing and spreading your risk. These ETFs are passively managed by professionals. So you don't have to worry about watching the stock market. Is it going up? Is it going down? Is it going sideways? You don't have to watch the stock market daily, monthly, weekly. You just set it and forget it and let that wealth compound over time for you. You are letting your dollars work hard for you so you don't have to. The first ETF I want to cover is XEQT, which is the iShares Core Equity ETF portfolio. The purpose of this particular ETF is to provide long-term capital appreciation by investing in primarily Canadian, US, and international markets. On the other side, we have VEQT, which is the Vanguard version of XEQT, which stands for the All Equity ETF portfolio. Similar to XEQT, the goal for this ETF is also to provide long-term capital appreciation through investing in Canadian, US, and international markets. And one thing that is very similar about both these ETFs is that they invest 100% in stocks, so you're not getting any bond exposure if that's something you're looking to avoid. It's all equity-based. Now let's go ahead and get into the nitty-gritty and look at the detailed behind these ETFs. So first, let's talk about asset allocation. As I just said before, they are 100% asset allocated to equity portfolios. This means that they are aggressive growth funds, so you will see near-term volatility. So if you are faint of heart, this is not for you. So short-term volatility, but they are perfect for the long run. Now, in terms of geographical exposure, as I mentioned, they are spread across US, Canadian, and international markets. Well, let's take one step closer in terms of how that really shakes out. XEQT gives you 25% exposure to Canadian markets and a rough 45% exposure to the US. Now, while VEQT, on the other hand, offers roughly a 30% stake in Canada and a similar 45% allocation to US, just like XEQT. So as you can see, the difference between these two ETFs is plus or minus 5% to Canada. If you want more towards Canada, VEQT at 30%, less exposure to Canada, XEQT at roughly 25%. When it comes to fees, yes, every penny does count. What's the difference between these two if they're so similar in nature? Well, XEQT's management expense ratio, or MER, is roughly 20 basis points. VEQT, on the other hand, is 24 basis points. But what does that really mean, that basis points differential of 4? Well, if you have $10,000 invested in either of those funds, for every $10,000 you have invested, that difference between 24 basis points for VEQT and 20 basis points for XEQT roughly translates to an annual incremental cost between the two of $4. So that means if you invest in VEQT versus XEQT and you have $10,000 invested, you're going to end up paying $4 more per annum per year in management fees. That's like a cup of coffee per year between the two, so not a huge deal. This management fee, even at $100,000, you're paying an extra $40 per year. Again, it's not a huge deal in the grand scheme of things. For me, the driving factor wouldn't be just management fees alone. Now, taking a look at the performance of these two ETFs since their inception, XEQT has slightly edged out VEQT. It's not a huge marginal difference. However, having said all that, past performance is not an indicator of future results, so please do keep that in mind. But basically what that means is even though XEQT has slightly edged out VEQT, that doesn't mean that's going to be the case the next year, 2 years, 5 years, 30 years, etc. Now let's focus on the income side. Even though these are aggressive growth funds, you do get a decent amount of income from them on a quarterly or annual basis. If you're looking for more income, XEQT has a higher 12-month trailing yield at roughly 1.98%. And that is more tempting, or it may be more tempting for you, depending on your circumstances. Compare that to VEQT, which has a 12-month trailing yield at 1.72%. But remember, we're here for growth, not just income. It's these slight differences you'll see between the two that may help you pick one versus the other. Now, a common question I hear from investors when it comes to VEQT and XEQT is around VFV, another ETF. Basically, what I hear is that if you're going to make a portfolio with either XEQT or VEQT, is it worth augmenting or supplementing that portfolio with an ETF by the name of VFV? Now, while XEQT and VEQT provide a significant exposure to the US markets, as we just saw previously, VFV is an ETF that's focused on tracking the S&P 500, so it's just additional US exposure. That means just by adding VFV to your portfolio that either consists of XEQT or VEQT, you are just increasing your US exposure. So really, that may not be relevant to you if you don't want an increase to the US markets. If you're good with the exposure that you get that's baked into VEQT and XEQT from a US market perspective, then you don't need to supplement that with VFV. The point of these ETFs is to keep it simple, set it and forget it, let your wealth build over time and let the compounding magic do its thing. Now, one other common question I get asked from viewers like yourself is actually about my wardrobe. So my wardrobe is sponsored for this video by Fioboc. The clothing I'm wearing, as I mentioned, is by Fioboc, and guess what? It's actually got some pretty cool features. First of all, it's wrinkle-free, so that means no more ironing headaches. Just toss it in the machine, give it a wash, and you're pretty much good to go. Plus, it's all about sustainability, environmentally friendly, dyeing of fabrics, looking good while doing good. Count me in. So quick shout out to Fioboc for sponsoring this segment of the video. If you are interested in an option like this or any other garments by Fioboc, I will leave a link for them in the description below. Plus, use the coupon code SAVE20, SAV20, to get an extra 20% off for yourself, exclusively for you. The offer, those details in the description. Check them out. Now, when it comes to VEQT and XEQT from a risk and return perspective, and both these ETFs do come with a medium risk rating, which is based on how much of an ETF's return has changed year over year. Now, what it doesn't tell you is how volatile this ETF will be in the future, but generally speaking, it gives you some context that it's not the highest of the high risk return type of ETF, and it's not the lowest of the low return risk type of ETF, right in the middle, which makes sense to me because this ETF is diversified across all industries, across all sectors, across US, Canada, and international markets. So your money is really spread across multiple different companies and countries. Now, when it comes to return potential, what can you expect in the future? Well, the aim for both these ETFs is to pretty much mirror the market as a whole. And historically, the market has gone up as a whole. But this is where I'll point out that doesn't mean it's going to keep going up as a whole. Well, that really depends on your perspective of humanity. Do you feel like humanity has reached its potential and we can no longer grow? We can no longer get more efficient? There's always something new coming out of the market. There's always something bigger and better. If you look back 100 years ago, 1,000 years ago, we are so much more ahead. And likely, if we keep growing as humanity, we should continue to get ahead. And with that being the case, the markets should continue to grow and expand as new industries develop, as technology develops, as we develop our own capabilities. Now that we've taken a look at what these ETFs are all about, who should invest in this ETF? Like what type of investor are these ETFs really suited for? The simple answer is that if you are a new beginner investor in Canada who is looking for a simple, cost-effective way to set it and forget it, let your money do the work for you without having to do individual research on stocks, these two are the best options for you to consider. Because you're pretty much putting your money growth in the stock market, and that growth you're putting on autopilot with VEQT or XEQT. And the best part is, with a single transaction, you are globally diversified across like 10,000 different companies. Yes, 10,000 different companies worldwide. That's why people love VEQT and XEQT, because you're not getting 10 stocks, 100 stocks, 1,000 stocks. You're getting close to between 9,000 for XEQT or around 13,000 for VEQT. That's how much diversification you are getting. And remember, these are long-term investments. We're talking 10 years, we're talking 20 years, we're talking 30 years. You want to give these ETFs as much uninterrupted time to grow as much as possible. The longer you can stay in the market, the longer you can benefit from compound growth. And if you take away one thing from this video, let it be this: time in the market is always better than timing the market. Now at this stage, you might be thinking, well, sign me up. How can I get me some of that XEQT or VEQT? Well, let me show you how. It's actually quite simple. You can buy XEQT or VEQT like you would any stock using your online brokerage, whatever brokerage you prefer. You pretty much sign into your local brokerage or online brokerage, whatever you prefer, like you would go on about buying a stock. You can place a market or a limit order for your brokerage, whatever you prefer. Once that order is executed at your desired price, VEQT or XEQT will be added to your investment portfolio. Now what I'll do for you is I will leave a link to Wealthsimple in the description below, so if you are interested in signing up for an online brokerage, Wealthsimple is a great option, super easy to use. Now to wrap it up, both XEQT and VEQT are solid options. XEQT gives you a little bit lower exposure to Canada and is the most cost-effective, only by 4 basis points, but still cost-effective between the two, while VEQT gives you more exposure to Canada and it's by Vanguard. So really, when I think about it, it's like choosing between Coke and Pepsi. It really all comes down to personal preference. You can't go wrong with either or. Take a look at this video, go through the comparisons I did, and again, there are very minor differences between the two. So that's why both options are really, really good options. And if it helps, I've personally actually invested in VEQT for my portfolio, and I can rest at night seeing my money grow. So if that helps make a decision there, so be it. If you are in it for the long haul, it won't really matter which one you choose. You can take a look at this graph right here, which actually shows you the comparison between XEQT and VEQT and their long-term performance since inception. And just take a look at this graph. Like, you can see how close they are to one another. It's not going to make or break whichever one you choose. Again, your goal should be to invest for the long run, stay in the market, don't time the market, and stay in the market for as long as possible. Everything else will take care of itself. So did you find this comparison helpful? Let me know your thoughts in the comment section down below. Which ETF are you leaning towards and why? That feedback really helps me create more content that matters to you, and that's what I want out of this, content that matters to you. So let me know your thoughts and feedback in the comments down below. So if you are ready to start your investment journey, again, don't forget to hit that like, subscribe, and thanks button. It really means a lot, that support you can offer to this channel, so I can keep making content that matters towards your investing journey. Please do check out the links in the description below. I have links to Wealthsimple so you can check them out, so you can add VEQT or XEQT to your portfolio. I'll link to Fioboc, so if you're interested in a shirt like this, you can grab one for yourself, save 20% off their amazing clothing. All other links to my investment portfolio, some of the spreadsheets that I've developed, Everything you can need is down there. Check it out. That's it for now. I'll talk to you in the comments section.